to the technical issue, the volume of the chapter 1 video is too low. So we use the AI generate voice as the temporary solution for the chapter 2 video, and we will restore it to a real human voice in the future versions. Thank you.
This chapter introduces financial statements. Subsequent chapters present a detailed review of the principal financial statements. Chapter 3 covers the balance sheet, Chapter 4 the income statement, and Chapter 10 the statement of cash flows. In Taiwan, we usually add the statement of changes in equity and call them the 4 major statements, but we will focus on the first 3 statements. And we will review the forms of business entities and the sequence of accounting procedures, called the accounting cycle. Other financial reporting topics included in this chapter that contribute to the understanding of financial reporting are Treadway Commission, Auditor's Opinion, Auditor's Report on the firm's internal controls, Report of Management on internal control over financial reporting, Management's responsibility for financial statements, the SEC's Integrated Disclosure System, Proxy, the Summary Annual Report, the Efficient Market Hypothesis, Ethics, Harmonization of International Accounting, Standards, Consolidated Statements, and Accounting for Business Combinations. A business entity may be a sole proprietorship, a partnership, or a corporation. A sole proprietorship, a business owned by one person, is not a legal entity separate from its owner, but the accountant treats the business as a separate accounting entity. The profit or loss of the proprietorship goes on the income tax return of the owner. The owner is responsible for the debts of the sole proprietorship. In the United States, a sole proprietorship may qualify to be treated as a limited liability company, LLC. As an LLC, the owner may limit the liability of the sole proprietor, but may increase the tax exposure of the proprietorship. A partnership is a business owned by 2 or more individuals. Each owner, called a partner, is personally responsible for the debts of the partnership. The accountant treats the partners and the business as separate accounting entities. The profit or loss of the partnership goes on the individual income tax return of the partners. Like a proprietorship, a partnership may qualify to be treated as an LLC. As an LLC, the owners may limit the liability of the partners, but may increase the tax exposure of the partnership. Accounting for corporations, sole proprietorships, and partnerships is the same, except for the owner's equity section of the balance sheet. The owner's equity section for a sole proprietorship consists of the owner's capital account, whereas the owner's equity section for a partnership has a capital account for each partner. The more complicated owner's equity section for a corporation will be described in detail in this book. Exhibit 2-1 illustrates the interrelationship of the balance sheet, income statement, and statement of cash flows. The most basic statement is the balance sheet. The other statements explain the changes between 2 balance sheet dates. A balance sheet shows the financial condition of an accounting entity as of a particular date. The balance sheet consists of 3 major sections: assets, the resources of the firm; liabilities, the debts of the firm; and stockholders' equity, the owner's interest in the firm. At any point in time, the total assets must equal the total amount of the contributions of the creditors and owners. This is expressed in the accounting equation. Assets equals liabilities plus stockholders' equity. In simplistic form, the stockholders' equity of a corporation appears as follows. In simplistic form, the stockholders' equity of a corporation appears as follows. This indicates that stockholders contributed, invested, $200,000, and prior earnings less prior dividends have been retained in the entity in the amount of $50,000, retained earnings. Firms are required to present reconciliations of the beginning and ending balances of their stockholders' equity accounts. This is accomplished by presenting a statement of stockholders' equity. Retained earnings is one of the accounts in stockholders' equity. Retained earnings links the balance sheet and the income statement. Retained earnings is increased by net income and decreased by net losses and dividends declared. For the purposes of this chapter, retained earnings will be described as prior earnings less prior dividends. Firms usually present the reconciliation of retained earnings within a statement of stockholders' equity. Some firms present the reconciliation of retained earnings at the bottom of the income statement, combined income statement and retained earnings. In this case, the other stockholders' equity accounts may be reconciled in a statement that excludes retained earnings. An additional review of the statement of stockholders' equity is in Chapter 3. The income statement summarizes revenues and expenses and gains and losses, ending with net income. It summarizes the results of operations for a particular period of time. Net income is included in retained earnings in the stockholders' equity section of the balance sheet. This is necessary for the balance sheet to balance. The statement of cash flows details the inflows and outflows of cash during a specified period of time, the same period that is used for the income statement. The statement of cash flows consists of 3 sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Notes are an integral part of financial statements. They explain amounts on the face of the statements and provide additional information needed for a fair understanding, so careful review is essential. Certain disclosures are mandatory. The first note, or a separate summary of significant accounting policies, must describe key policies, such as inventory valuation methods and depreciation policies, that materially affect measurement and comparability. Notes must also address contingent liabilities and certain subsequent events. A contingent liability is a potential obligation whose existence or amount depends on future events, for example, the outcome of litigation, a tax court ruling, or obligations taken on by guaranteeing another party's debt. Reporting depends on likelihood and measurability. If a loss is probable and reasonably estimable, the company must accrue a liability and expense and typically describe the matter in a note. If a loss is reasonably possible but not probable, the company must disclose the nature and, if feasible, the range of loss. No accrual is recorded. If the likelihood is remote, disclosure is generally not required, though management may still disclose when the potential loss is unusually large or significant. These rules balance relevance and reliability and enhance users' understanding of risk. The accounting cycle is the repeatable, period-by-period process a business uses to record, summarize, and report its financial activity. It runs from the first recognition of a transaction to closing the books and preparing for the next period. Depending on the standards and practices used, it may be outlined in 6 to 10 steps. For this overview, we'll group it into 3 broad phases, each of which can be broken down into more specific substeps. 1. Recording transactions, 2. Recording adjusting entries, 3. Preparing the financial statements. A transaction is an event that causes a change in a company's assets, liabilities, or stockholders' equity, thus changing the company's financial position. Transactions may be external or internal to the company. External transactions involve outside parties, while internal transactions are confined within the company. For example, sales is an external transaction, whereas the use of equipment is an internal transaction. Transactions must be recorded in a journal, book of original entry. All transactions could be recorded in the general journal. However, companies use a number of special journals to record most transactions. The special journals are designed to improve efficiency that could not be obtained by using only the general journal. The general journal is then used only to record transactions for which the company does not use a special journal. A transaction recorded in a journal is referred to as a journal entry. All transactions are recorded in a journal entry, and are later posted from the journals to a general ledger, group of accounts for a company. After posting, the general ledger accounts contain the same information as the journals, but the information has been summarized by account. Accounts store the monetary information from the recording of transactions. Examples of accounts include cash, land, and buildings. An accounting system may be manual or computerized. A manual system using T-accounts is usually used for textbook explanations because a T-account is a logical format. T-accounts have a left debit side and a right credit side. An example T-account follows. A double-entry system has been devised to handle the recording of transactions. In a double-entry system, each transaction is recorded, with the total dollar amount of the debits equal to the total dollar amount of the credits. The scheme of the double-entry system revolves around the accounting equation. Assets equals liabilities plus stockholders' equity. With the double-entry system, debit merely means the left side of an account, while credit means the right side. Each transaction recorded must have an equal number of dollars on the left side as it does on the right side. Several accounts could be involved in a single transaction, but the debits and credits must still be equal. The debit and credit technique has gained acceptance over a long period of time. This book will not make you competent in the use of the double-entry bookkeeping, debit and credit, technique. Rather, it will enhance your understanding of the end result of the accounting process and enable you to use the financial accounting information in a meaningful way. Notice that the permanent accounts are represented by the accounting equation. Assets equals liabilities plus stockholders' equity. The temporary accounts are represented by revenue, expense, and dividends. Gains and losses would be treated like revenue and expense, respectively. The balance sheet will not balance until the temporary accounts are closed to retained earnings. Earlier, a distinction was made between the accrual basis of accounting and the cash basis. It was indicated that the accrual basis requires that revenue be recognized when realized, realization concept, and expenses recognized when incurred, matching concept. The point of cash receipt for revenue and cash disbursement for expenses is not important under the accrual basis when determining income. Usually, a company must use the accrual basis to achieve a reasonable result for the balance sheet and the income statement. The accrual basis needs numerous adjustments to account balances at the end of the accounting period. For example, $1,000 paid for insurance on October 1st for a one-year period, October 1st to September 30th, could have been recorded as a debit to insurance expense, $1,000, and a credit to cash, $1,000. If this company prepares financial statements on December 31st, it would be necessary to adjust insurance expense because not all of the insurance expense should be recognized in the 3-month period October 1st to December 31st. The adjustment would debit prepaid insurance, an asset account, for $750 and credit insurance expense for $750. Thus, insurance expense would be presented on the income statement for this period as $250, and an asset, prepaid insurance, would be presented on the balance sheet as $750. Adjusting entries are recorded in the general journal and then posted to the general ledger. Once the accounts are adjusted to the accrual basis, the financial statements can be prepared. The accountant uses the accounts after the adjustments have been made to prepare the financial statements. These statements represent the output of the accounting process. For the principal financial statements, the income statement and the balance sheet are prepared directly from the adjusted accounts. Preparation of the statement of cash flows requires further analysis of the accounts. Treadway Commission is the popular name for the National Commission on Fraudulent Financial Reporting named after its first chairman, former SEC Commissioner James C. Treadway. The Commission has issued a number of recommendations for the prevention of fraudulent financial reports, ethics, and effective internal controls. The Treadway Commission is a voluntary private sector organization formed in 1985 that the Committee of Sponsoring Organizations of the Treadway Commission, COSO, has released reports detailing internal control systems. These reports represent the standard for evaluating the effectiveness of internal control systems. Section 404 of the Sarbanes-Oxley Act emphasizes the importance of internal control and makes management responsible for internal controls. The independent public accounting firm is required to give an opinion as to management's assessment of internal control and the effectiveness of internal control over financial reporting as of the balance sheet date. The management's report on internal control over financial reporting and the independent public accounting firm report to the shareholders, and the board of directors often refers to the criteria established on internal control by COSO. Auditor's opinion. An auditor, certified public accountant, conducts an independent examination of the accounting information presented by the business and issues a report thereon. An auditor's report is the formal statement of the auditor's conclusions as to whether the financial statements after conducting an audit. Audit opinions are classified as follows. 1. Unqualified opinion. This opinion states that the financial statements present fairly, in all material respects, the financial position, results of operations, and cash flows of the entity, in conformity with generally accepted accounting principles. 2. Qualified opinion. A qualified opinion is issued when the auditor concludes that, except for the effects of the matters to which the qualification relates, the financial statements present fairly, In all material respects, the financial position, results of operations, and cash flows of the entity, in conformity with generally accepted accounting principles. 3. Adverse opinion. This opinion states that the financial statements do not present fairly the financial position, results of operations, and cash flows of the entity, in conformity with generally accepted accounting principles. 4. Disclaimer of opinion. A disclaimer of opinion states that the auditor does not express an opinion on the financial statements. A disclaimer of opinion is rendered when the auditor has not performed an audit sufficient in scope to form an opinion. Since the passage of Sarbanes-Oxley, the form of the audit opinion can vary substantially. Private companies are not under Sarbanes-Oxley, but an increasing number of private companies are complying with parts of the law. Some of the reasons for private companies to follow the law are the following. Owners hope to sell the company or take it public. Directors who sit on public company boards see the law's benefits. Executives believe strong internal controls will improve efficiency. Customers require strong internal controls. Lenders are more likely to approve loans. The typical unqualified or clean opinion for private companies has 3 paragraphs. The first paragraph indicates that the financial statements have been audited and are the responsibility of the company's management. This paragraph states that the audit was conducted to express an opinion on the financial statements. The second paragraph indicates that the audit has been conducted in accordance with generally accepted auditing standards. This will typically be expressed in terms of standards of the Public Company Accounting Oversight Board, United States. These standards require the auditor to plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement. This paragraph also confirms that the audit provided a reasonable basis for an opinion. The third paragraph gives an opinion on the statements, that they are in conformity with GAAP. In certain circumstances, an unqualified opinion on the financial statements may require the auditor add an explanatory paragraph after the opinion paragraph. In this paragraph, the auditor may express agreement with a departure from a designated principle, describe a material uncertainty, detail a change in accounting principle, or express doubt as to the ability of the entity to continue as a going concern. An explanatory paragraph may also be added to emphasize a particular matter. The audit opinion of a public company is similar to an opinion for a private company, except that the public company comments will be added as to the effectiveness of internal control over financial reporting. An opinion is expressed as to management's assessment of the effective operation of internal control over financial reporting. When an unqualified opinion contains an explanatory paragraph or when there is qualified language, try to decide how seriously to regard the departure from a straight, unqualified opinion. For example, an explanatory paragraph because of a lack of consistency in accounting principles would not usually be regarded as serious, although the departure might redirect your analysis. An explanatory paragraph because of a material uncertainty can be regarded as a more serious matter. You are likely to regard a qualified opinion or an adverse opinion as casting serious doubts on the reliability of the financial statements. In each case, you must read the statements and the report carefully to form your opinion. A disclaimer of opinion indicates that you should not look to the auditor's report as an indication of the reliability of the statements. When rendering this type of report, the auditor has not performed an audit sufficient in scope to form an opinion, or the auditor is not independent. Exhibit 2 to 5 presents the audit report for T. Rowe Price Group Incorporated. It is an unqualified opinion. Exhibit 2 to 6 presents the auditor's report on T. Rowe Price Group, Inc.'s internal controls. In some cases, outside accountants are associated with financial statements when they have performed less than an audit. The accountant's report then indicates that the financial statements have been reviewed or compiled. A review consists principally of inquiries made to company personnel and analytical procedures applied to financial data. It has substantially less scope than an examination in accordance with generally accepted auditing standards, the objective of which is the expression of an opinion regarding the financial statements taken as a whole. Accordingly, the accountant does not express an opinion. The accountant's report will indicate that the accountants are not aware of any material modifications that should be made to the financial statements in order for them to be in conformity with GAAP, or the report will indicate departures from GAAP. A departure from GAAP may result from using one or more accounting principles without reasonable justification, the omission of necessary note disclosures, or the omission of the statement of cash flows. In general, the reliance that can be placed on financial statements accompanied by an accountant's review report is substantially less than those accompanied by an audit report. Remember that the accountant's report does not express an opinion on reviewed financial statements. When the outside accountant presents only financial information as provided by management, he or she is said to have compiled the financial statements. The compilation report states that the accountant has not audited or reviewed the financial statements. In addition, the accountant does not express an opinion or any other form of assurance about them. If an accountant performs a compilation and omits substantially all disclosures, it should be noted that the accountant's report characterizes the deficiencies as follows. Omission of substantially all disclosures. Omission of statement of cash flows. Accounting principles not generally accepted. Sometimes financial statements are presented without an accompanying accountant's report. This means that the statements have not been audited, reviewed, or compiled. Such statements are solely the representation of management. Under Sarbanes-Oxley, management of public companies must present a report of management on internal control over financial reporting. Exhibit 2 to 7 presents the Internal Control Report of Management for T. Rowe Price Group Incorporated that was presented with its 2010 annual report. The responsibility for the preparation and for the integrity of financial statements rests with management. The auditor is responsible for conducting an independent examination of the statements and expressing an opinion on the financial statements based on the audit. To make financial statement users aware of management's responsibility, some companies have presented management statements to shareholders as part of the annual report. Exhibit 2 to 8 shows an example of a report of management's responsibility for financial statements as presented by Kellogg Company in its 2010 annual report. In general, in the United States, the SEC has the authority to prescribe external financial reporting requirements for companies with securities sold to the general public. Under this jurisdiction, the SEC requires that certain financial statement information be included in the annual report to shareholders. This annual report, along with certain supplementary information, must then be included or incorporated by reference in the annual filing to the SEC, known as the 10-K report or Form 10-K. The Form 10-K is due 60 days, 75 days, or 90 days following the end of the company's fiscal year, depending on the market value of the common stock. The annual report and the Form 10-K include audited financial statements. The SEC promotes an integrated disclosure system between the annual report and the Form 10-K. The goals are to improve the quality of disclosure, lighten the disclosure load, standardize information requirements, and achieve uniformity of annual reports and Form 10-K filings. SEC requirements force management to focus on the financial statements as a whole rather than just the income statement and operations. Where trend information is relevant, discussion should center on the 5-year summary. Emphasis should be placed on favorable and unfavorable trends and on identifying major uncertainties. The discussion should provide analysts with a reasonable summary of these trends and uncertainties. Exhibit 2 to 10 presents a summary of the major sources of the required information in the Form 10-K. In practice, some information may be incorporated by reference, meaning the information is presented outside the Form 10-K, for example, in the annual report, and the Form 10-K points to where it can be found. The SEC requires that a quarterly report, Form 10-Q, containing financial statements and a management discussion and analysis, be submitted within either 40 or 45 days following the end of the quarter, depending on the market value of the common stock. See Exhibit 2 to 9. The Form 10-Q is not required for the fourth quarter of the fiscal year. Most companies also issue a quarterly report to stockholders. The Form 10-Q and quarterly reports are unaudited. In addition to the Form 10-K and Form 10-Q, a Form 8-K must be submitted to the SEC to report special events. Some events required to be reported are changes in principal stockholders, changes in auditors, acquisitions and divestitures, bankruptcy, and resignation of directors. The Form 8-K is due 15 days following the event. The Forms 10-K, 10-Q, and 8-K filings are available to the public. Many companies are reluctant to send these reports to non-stockholders. In public companies, these reports can be found at SEC website www.sec.gov. Exhibit 2 to 11 presents a summary of the major parts of the Form 10-Q. As with the 10-K, in practice some of the required information is incorporated by reference. We take a break 5 minutes. Take a moment to reflect. What did you learn in today's class? Don't forget to log into iLearning 2.0 and complete this week's discussion post, worth 1% of your final grade each week. Before class ends, please check if this week's assignment, worth 2 to 3% each time, needs to be submitted. Upload it to the assignment section. Weekly tasks are a significant component of your final grade and will impact your final project. Completing them gradually will make a huge difference. Welcome back. I remind you again to complete the online quiz on iLearning 2.0. The proxy, the solicitation sent to stockholders for the election of directors and for the approval of other corporation actions, represents the shareholder authorization regarding the casting of that shareholder's vote. The proxy contains notice of the annual meeting, beneficial ownership, name, address, and share ownership data of shareholders holding more than 5% of outstanding shares, board of directors, standing committees, compensation of directors, compensation of executive officers, employee benefit plans, certain transactions with officers and directors, relationship with independent accountants, and other business. The SEC's proxy rules of particular interest to investors involve executive compensation disclosure, performance graph, and retirement plans for executive officers. These rules are designed to improve shareholders' understanding of the compensation paid to senior executives and directors, the criteria used in reaching compensation decisions, and the relationship between compensation and corporate performance. The pension plan table for executive officers discloses the estimated annual benefits payable upon retirement for any defined benefit or actuarial plan under which benefits are determined primarily by final compensation or average final compensation and years of service. Immediately following the table, additional disclosure is required. This disclosure includes items such as the relationship of the covered compensation to the compensation reported in the summary compensation table and the estimated credited years of service for each of the named executive officers. A reporting option available to public companies is to issue a summary annual report. A summary annual report, a condensed report, omits much of the financial information typically included in an annual report. A typical full annual report has more financial pages than non-financial pages. A summary annual report generally has more non-financial pages. When a company issues a summary annual report, the proxy materials it sends to shareholders must include a set of fully audited statements and other required financial disclosures. A summary annual report is not adequate for reasonable analysis. For companies that issue a summary annual report, request a copy of their proxy and the Form 10-K. Even for companies that issue a full annual report, it is also good to obtain a copy of the proxy materials and the Form 10-K. Some companies issue a joint annual report and Form 10-K, while other companies issue a joint annual report and proxy. A few companies issue a joint annual report, Form 10-K, and proxy. These joint reports are usually labeled as the annual report. The efficient market hypothesis, EMH, relates to the ability of capital markets to generate prices for securities that reflect worth. The EMH implies that publicly available information is fully reflected in share prices. The market will not be efficient if the market does not have access to relevant information or if fraudulent information is provided. There seems to be little doubt that the FASB and the SEC assess the impact of their actions on security prices. The SEC has been particularly sensitive to insider trading because abnormal returns could be achieved by the use of insider information. It is the disclosure rather than how to disclose that is the substantive issue. Usually, there is a cost to disclose. An attempt should be made to determine the value of additional disclosure in relation to the additional cost. Disclosure should be made when the perceived benefits exceed the additional cost to provide the disclosure. Although the research evidence regarding the EMH is conflicting, this hypothesis has taken on an important role in financial reporting in the United States. Ethics and morals are synonymous. While ethics is derived from Greek, morals is derived from Latin. They are interchangeable terms referring to ideas of character and right behavior in the form of codes of conduct, curriculum criteria for distinguishing right from wrong, and the like. Ethics has been a subject of investigation for hundreds of years. An individual in a financial position must be able to recognize ethical issues and make decisions that will contain importance. Ethics affect all individuals, from the financial clerk to the high-level financial executive. Individuals make daily decisions in the conduct of their affairs. Professional organizations have adopted codes of ethics which provide guidance as to a statement of principles and a standard of integrity beyond that required by law, which can be viewed as the minimum standard of ethics. In 1988, the American Accounting Association initiated a project on professionalism in ethics. One of the goals of this project was to provide students with a framework for evaluating their courses of action when encountering ethical dilemmas. The American Accounting Association developed a decision model for focusing on ethical issues. One that determined the facts: what, who, where, when. Two that define the ethical issues, includes identifying the identifiable parties affected by the decision made or action taken. 3. That identify major principles, rules, and values. 4. Specify the alternatives. 5. Compare norms, principles, and values with alternatives to see if a clear decision can be reached. 6. Assess the consequences. 7. Make your decision. Ethics can be a particular problem with financial reports. Accepted accounting principles leave ample room for arriving at different results in the short run. Highly subjective estimates can substantially influence earnings. What provision should be made for warranty costs? What should be the loan loss reserve? What should be the allowance for doubtful accounts? In January 2003, the SEC voted to require disclosure in a company's annual report as to whether it has a code of ethics that applies to the company's principal executive officer, principal financial officer, principal accounting officer or controller, or persons performing similar functions. The rules will define a code of ethics as written standards that are reasonably necessary to deter wrongdoing and to promote 1. Honest and ethical conduct, including the ethical handling of actual or apparent conflicts of interest between personal and professional relationships. 2. Full, fair, accurate, timely, and understandable disclosure in reports and documents that a company files with or submits to the 3. Commission and in other public communications made by the company. Compliance with applicable governmental laws, rules, and regulations. 4. The prompt internal reporting of code violations to an appropriate person or persons identified in the code. 5. Accountability for adherence to the code. The SEC voted to require disclosure in a company's annual report as to whether it has a code of ethics that applies to the company's principal executive officer, principal financial officer, principal accounting officer or controller, or persons performing similar functions. The rules will define a code of ethics as written standards that are reasonably necessary to deter wrongdoing and to promote. Financial statements of legally separate entities may be issued to show financial position, income, and cash flow as they would appear if the companies were a single entity, consolidated. Such statements reflect an economic, rather than a legal, concept of the entity. For consolidated statements, all transactions between the entities being consolidated, intercompany transactions, must be eliminated. This portrays the resulting financial statements as a single company. The parent company concept emphasizes the interests of the controlling shareholders, the parent's shareholders. A subsidiary is a company controlled by another company. An unconsolidated subsidiary is accounted for as an investment on the parent's balance sheet. Two reporting approaches can be used to present consolidated statements. In one approach, the subsidiary's accounts are shown separately from the parent's. This format is logical when the parent has a subsidiary in a different line of business. Ford Motor Company consolidates, presenting the automotive and financial services categories separately. Most companies consolidate the parent and subsidiary accounts in total. The Dow Chemical Company consolidates summaries. The combination of business entities by merger or acquisition is very frequent. There are many possible reasons for this external business expansion, including achieving economies of scale and savings of time in entering a new market. The combination must be accounted for using the purchase method. The purchase method views the business combination as the acquisition of one entity by another. The firm doing the acquiring records the identifiable assets and liabilities at fair value at the date of acquisition. The difference between the fair value of the identifiable assets and liabilities and the amount paid is recorded as goodwill, an asset. In Chapter 1, it was reported that the Securities Act of 1933 was designed to protect investors from abuses in financial reporting in the United States. This act was intended to regulate the initial offering and sale of securities in interstate commerce. Also, in Chapter 1, it was reported that, in general, the Securities Exchange Act of 1934 was intended to regulate securities trading on the national exchanges, and it was under this authority that the Securities and Exchange Commission, SEC, was created. The SEC required these reports to be filed using paper documents. By 1996, the SEC installed its electronic disclosure system, EDGAR. The SEC made the EDGAR filings available on the Internet. Not all reports to the SEC are made available on EDGAR. In 2004, the SEC began investigating the possibility of having companies submit data in a tagged format, XBRL. XBRL stands for Extensible Business Reporting Language. The XBRL approach does not eliminate the existing filing requirements. The XBRL approach is not unique with the SEC as it is used for many products and many countries. For example, the barcode for items in a grocery store. Many countries have started to use barcodes, interactive data, in their financial disclosure statements. Let's quickly review the summary and key points of this chapter. An understanding of the sequence of accounting procedures completed during each accounting period, called the accounting cycle, will help in understanding the end result, financial statements. This chapter describes the forms of business entities, which are sole proprietorship, partnership, and corporation. Management is responsible for financial statements. These statements are examined by auditors who express an opinion regarding the statement's conformity to GAAP in the auditor's report. The auditor's report often points out key factors that can affect financial statement analysis. The SEC has begun a program to integrate the Form 10-K requirements with those of the annual report. Let's quickly review the summary and key points of this chapter. An understanding of the sequence of accounting procedures completed during each accounting period, called the accounting cycle, will help in understanding the end result, financial statements. This chapter describes the forms of business entities, which are sole proprietorship, partnership, and corporation. Management is responsible for financial statements. These statements are examined by auditors who express an opinion regarding the statement's conformity to GAAP in the auditor's report. The auditor's report often points out key factors that can affect financial statement analysis. The SEC has begun a program to integrate the Form 10-K requirements with those of the annual report. Let's quickly review the summary and key points of this chapter. An understanding of the sequence of accounting procedures completed during each accounting period, called the accounting cycle, will help in understanding the end result, financial statements. This chapter describes the forms of business entities, which are sole proprietorship, partnership, and corporation. Management is responsible for financial statements. These statements are examined by auditors who express an opinion regarding the statement's conformity to GAAP in the auditor's report. The auditor's report often points out key factors that can affect financial statement analysis. The SEC has begun a program to integrate the Form 10-K requirements with those of the annual report.
Here, that is all about the contents about the chapter 2 discourse. So after the video, remember you should check the online iLearning 2.0, complete the online quiz, and also check the discussion fund topic and please comment it. Uh, and also, we have any online homework, please submit it by the deadline. Almost is the next week. The This video always available for the review. If you have any further questions, you can feel comfortable to contact me. You have my lines and email, and you also can use in the I.0's discussion forums about the public that ones. So if you don't have question, just please just check it again and feel comfortable for you. Thank you.